Hi, I'm Suzy Rhodes with Pass Masters. Welcome to this week's Questions of the Week. This week, our topic is portfolio management strategies, styles, and techniques. You can expect to find this topic on your Series 6, Series 7, Series 65, and Series 66. We will take a 15-question topic quiz from within one of our Past Masters Securities courses. Let's check out our learning management system. An investment advisor has invested $300 a month for the past 5 years for a client. This is known as choices include hedging your bets, aggressive investing, dollar cost averaging, or Monte Carlo simulation. Investing the same amount of money at regular intervals, that's dollar cost averaging. So you click what you believe is the correct answer, click check answer. You know you got it right if you get that green check mark. If you have questions as to what the right answer is, what was wrong with what you chose, you'll click show explanation. You'll have that opportunity to read the rationale as well as an investment advisor has invested. There's me! It's an audio explanation for every one of our practice exam questions. So be sure to use these tools that are available to you within our programs. So it's a common question my friends will always ask me, when should I invest all of my money in the stock market? I don't know. Obviously, I don't have that magic crystal ball. But if you invest the same amount of money at regular intervals, you'll get more shares when the price is the lowest, and you'll get less shares when the price is the highest. Certainly, if you knew when the price was going to be the lowest, you'd dump all your money in when it was the lowest, but we don't know when that is. So with dollar cost averaging, you'll have an average cost that is less than the average price per share. It does not guarantee that you will make money, but it is a defensive strategy, and it is commonly encouraged by mutual fund companies. Which of the following styles of portfolio management is passive? Sector rotation, buy and hold, tactical asset allocation, or contrarian. So passive means there's not going to be a lot of trading going on. Of those, the one that's passive is buy and hold. Tactical asset allocation is active. Look at it. It has the word act right in it. Buy and hold is passive. When creating a portfolio for your client to use to fund her 18-year-old son's college expenses, which would make the most sense? So the kid's 18. When are they going to go to college? I'm going to assume soon. All of the money in an index fund, a ladder of bonds maturing over the next 5 years, 20% in bonds and 80% in equities, or cash in a savings account at the local bank. So if you were in an index fund, you would be in the market, and this kid's got a really short time horizon till when they're going to college. So college taking 4 to 6 years usually these days. Hopefully, fingers crossed, I have lots of kids, so yes. So index fund would be too aggressive. A ladder of bonds maturing over the next 5 years, that is a really good suggestion. That would make of these choices the most sense. Having 20% in bonds and 80% equities would be too aggressive for this situation. And having cash in a savings account, you're not going to have any earnings at all in your savings account, or infinitesimal earnings. So the best recommendation of these, a ladder of bonds maturing over the next 5 years, because gratefully, you don't pay college expenses all at once. You pay them a year at a time, semester at a time, I suppose. Which of the following would be passive? International fund, index fund, income fund, or sector fund? It is the index fund. So if you're an investment advisor to an index fund, you're not actively trading in that portfolio. The only time you are making changes to the index fund's portfolio is when the index itself changes. Investment advisors of index funds attempt to mirror the index. Passive. All are ways to manage a portfolio's volatility except. So rewording it without the except, which one is not a way to manage a portfolio's volatility? Buy assets with low to no correlation, purchasing dividend-paying stocks, investing in a broad index fund, or diversify by asset class. So which one of these is not a way to manage a portfolio's volatility? Investing in a broad index fund would not be a way to manage a portfolio's volatility. So volatility is that up and down motion of the stock market. So to buy assets with low to no correlation would help. It would help to manage a portfolio's volatility. Purchasing dividend-paying stocks, that would also help. Diversify by asset class helps to manage a portfolio's volatility. But an index fund, they're all in equities, so that would not help to manage a portfolio's volatility. Asset allocation involves choices include passive portfolio management, the spreading of risks among many different securities, the spreading of risks among many different asset classes, or active portfolio management. So asset allocation is the spreading of risks among many different asset classes. So cash, stocks, bonds, real estate. So a little bit in each of these various asset classes. Asset allocation. Which of the following portfolio management strategies is active? Passive? No. Tactical? Yes. Strategic? Passive. Buy and hold? Passive. Tactical asset allocation is an active portfolio management strategy where the investment advisor is going to buy stocks that he thinks is a good buy, sell stocks when he thinks that he should. Active management. Tactical asset allocation. Strategic asset allocation is passive. So asset allocation can be either active or passive. Strategic, passive, tactical, active. Which one of those two is going to have higher transaction costs? Tactical, because it's active. It engages in market timing. Owning a portfolio of stocks listed on the S&P 500 would be passive, conservative, contrarian, or active. So you're in stock, so it's not conservative, but you're only going to buy what is in the S&P 500. So that is passive. How is a publicly traded company's market capitalization determined? Choices include average stock price over the last year times number of issued shares of common stock. Common stock share price times number of shares in the hands of the public. I like that. Let's check the other two. Current assets divided by outstanding shares, owner's equity divided by, no. So it is market capitalization, common stock share price times the number of shares in the hands of the public. That's sometimes referred to as the public float. So when we say large cap, mid cap, small cap, we're talking about the market capitalization of the company. Dollar cost averaging is an investment technique that is, choices include defensive, suitable only for certain types of clients, prohibited or aggressive, dollar cost averaging, investing the same amount of money at regular intervals, that is defensive. A bond ladder strategy is used to, choices include maximize interest rate risk, diversify a portfolio, ensure a profit, or protect a portfolio from interest rate risk. So ladder, some mature in the next year, and then the next year, and then 10 years, and then 20 years, not all at once, right? So you think of like rungs of a ladder. So to protect a portfolio from interest rate risk, bond ladder strategy. An investment plan that attempts to maintain a relationship between debt and equity is which of the following? So debt is bonds and equity stocks. Is it a defensive plan, dollar cost averaging plan, constant ratio plan, or constant dollar plan? So we're looking to have a relationship between debt and equity, constant ratio plan. Which strategy involves timing the market? Strategic asset allocation, index mirroring, tactical asset allocation, or buy and hold? Well, 3 of those are passive and 1 of them is active. Which one is timing the market? That would be tactical asset allocation. Which type of asset allocation is passive? Choices include strategic asset allocation, periodic asset allocation, tactical asset allocation, or modern asset allocation. So there's 2 types of asset allocation, strategic and tactical. Periodic and modern are made up to trick you, so you can get rid of those ones. So strategic, that's passive. Tactical has the word act right in it, so tactical is active. Making changes to an asset allocation model over time is called correlating, rebalancing, sector rotation, or Monte Carlo. So strategic asset allocation, which is passive, is going to be subject to the need to rebalance the portfolio over time. Rebalancing, making changes to an asset allocation model over time. So if the stocks are way more than they're supposed to be, you're going to sell those stocks, they're high, and then move the money over, usually into bonds and some into cash, assuming our asset allocation was stocks, bonds, and cash. So subject to the need to rebalance, passive, strategic asset allocation. That concludes this week's questions of the week. We talked about portfolio management strategies, styles, and techniques. Be sure to give this video a thumbs up, subscribe to our channel if you're not already, and turn those notifications on. If you'd like to check out our Past Master Securities course offerings or to enroll in any of our programs, there is a link found in this video's description. Thank you so much for watching. Keep up the good work. I hope to have you as a student soon. Happy studies. You got this.